Assalamu alaikum everyone, this is Mohammad Sahrab and you are watching Evolve Edge Virtual Learning. Those who are new, I'm a student of PhD and before that I get certification from different institutes like I'm certified corporate financial analyst from NASBA, USA. NASBA stands for National Association of State Board of Accountancy, and I also taken certification in the field of financial modeling and forecasting from SAM Institute. Okay guys, today we will discuss DuPont framework analysis. If your company hasn't performed well and you want to know where the problem exists, or if you are going to invest in any company but before that you want to know its financial health, or if you are going to land a company but before that you want to see its operating performance, then DuPont framework famous in the field of financial analyst that will let you know about the performance of a company, that will let you know about the operating performance of a company, and it combines the measure of profitability, leverage and efficiency into one measure that called DuPont framework analysis. So in today's session we will do financial DuPont framework analysis, and on the basis of that analysis we will see the operating performance and financial health of a company. So let's go toward today's video.
Okay guys, you can see that we have a semi-limited balance sheet and its income statement, and we have benchmark balance sheet and their income statement. So the first task is to calculate their operating performance of these two companies, how we can measure their financial health. So for measuring operating performance and for measuring financial health of these companies, we will use return on equity.
And why actually we are calculating ROE, why ROE is so necessary to calculate, and why ROE is chosen as the performance measure? Because ROE let us know that how much income we have generated through the equity of owners. So that's why ROE is very necessary components, and it is the performance indicator.
Return on equity is computed by dividing net income by stockholder equities. Okay, so what actually return on equity will tell us? It is a measure of the amount of profit earned per dollar of investment. Okay, so first we will calculate return on equity, and return on equity will tell us the amount of profit that has been earned against the per dollar of investment by the owners. So once we have calculated return on equity, then we will implement DuPont framework on that.
If a company hasn't performed well and you want to know that why this company hasn't performed well, what is the problem with that company, for that you for that we use DuPont framework analysis, because DuPont framework analysis will let us know about the operating performance of a company, and we can know that what are the problem with that company and where is the problem with that company.
Oh guys, return on equity is computed by dividing our total income with total equity. We will calculate the return on equity of Soema Limited, and we will calculate return of equity of benchmark, and then we will see that how much amount is being earned by the owner of these companies. Okay, so how we can calculate return on equity? For that we need to have net income both of these companies, and we should have total equity of both of these companies. Okay, so the income of Soima Limited is 21,300. Okay, so this is the income of Soima Limited, and the income of benchmark is 21,300. Okay, so the income of both of these companies have same. So now we will see the total equity of these companies. So the total equity of Soima Limited is 1,50,000. This is the amount which is invested by the owners. Okay, so equity mean the amount which is invested by the owners, and the amount of benchmark is 4 lakh rupees. Okay, so in Swayam Limited, owners has invested 1,50,000, and in benchmark, owners has invested 4 lakh rupees in business. So now we will see their return on equity. So the return on equity of Swayam Limited is 21,000 divided by 1,50,000. So it is 14%, and the return on equity of benchmark is 5%. So return on equity of Swayam Limited is 14%, and the return on equity of benchmark is 5%.
So what does this figure indicate, and what does this 13% mean? It means that for every 100 rupees which were invested by the owners of Soyama Limited, they have earned a return of 13%. Okay, and in case of benchmark, it means that for every $100 or every 100 rupees which were invested by the owners of benchmark, they have earned 5% return on that amount. So what we can conclude that, and what is the favorable figure of ROE? Favorable figure of ROE is considered as 20%. If ROE of a company is 20%, that is considered as good, and if ROE is less than 10%, that considered not good, and companies having ROE between 10 to 20 is considered as normal. Okay, here in the case of Soima Limited, its ROE is normal because it is 13%, and ROE of benchmark is 5%, which is considered not good. So now we will use our DuPont framework analysis. We will try to find out the problem of benchmark, why benchmark hasn't performed well compared to Soyama Limited. Where is the issue with benchmark? Why its ROE is less than Soyama Limited? So this is our objective, and now we will see the problem. We will find out the problem that is exist with.
What does this 14% mean, and what does this 5% mean? This mean that for every $100 which were invested by the owners in Soima Limited, they have earned a return of 14%. And in benchmark, for every $100 which were being invested by the owners, they earn a return of 5%. Okay, so here we can see that Soima Limited have performed better than benchmark. Okay, so guys, we can see that both of these companies have same sales amount. Okay, Soima Limited has sales for 50,000, and benchmark has sales for 50,000, and both companies have same net profit. Then why benchmark haven't performed better? Why ROE of Soima Limited is better than benchmark? So we will see this through DuPont framework analysis, and DuPont framework analysis will let us know that where benchmark hasn't performed better, and how Soima Limited performed better than benchmark limited in term of profit, in term of return on equity. Okay guys, one more thing that we need to know is that ROE greater than 20 is considered good, and less than 10 is considered not good, and companies having return on equity between 10 and 20 is considered normal. Okay, so when it comes to return on equity, this is a general overall measure of company performance. Okay, so here Soima Limited has return on equity 14%. This is comparatively good than benchmark, which have 5% return on equity, which is considered not good. Okay, then now we will measure it on the basis of DuPont framework. Okay,
This DuPont framework have these three components. One is leverage, then second is efficiency, and then last is profitability.
as we have calculated return on equity of Swami Limited, it is 14%. Okay, and we have calculated return on equity of benchmark, it is 5%. Why Swami Limited has performed better than benchmark? So this is our objective right now, and DuPont framework will let us know that what is the problem with benchmark, why its return on equity is less than uh, ROE of Soima Limited. As we know that both companies have same number of total assets, and both companies have same sales, and both companies have same income. First of all, we will calculate leverage.
When it comes to leverage, it's an indicator of how much money we have borrowed to buy assets, and leverage ratio will let us know that how much assets we have purchased through owner equities and how much money we have borrowed to buy assets. And the question that arises here is that why actually we buy assets. The reason behind buying asset is that so that we make more sales. So when we have more sales, then definitely on the basis of that sale we will have more profitability. So first of all, we borrow money to buy assets, and then we buy assets to generate more and more sales, and we generate more sales to earn higher profit or higher income. Okay,
How we can calculate leverage? For calculating of leverage, we have to divide our total assets with total equity. So how we can calculate leverage? For calculating leverage, we have to divide our total assets with total equity. So the total assets of Soima Limited is 6 lakh, and we will divide it with total equity. So the borrowing of Soima Limited is 4.06, and benchmarks. Let's see how much amount is being borrowed by benchmark, whether it has utilized its uh, maximum capacity of borrowing or not. Okay, so whenever we borrow money, that will reduce the cost of capital. Amount of borrowing so the total amount of equity which is invested by the owners is 4 lakh. So the amount of equity which is being borrowed by Soima Limited is 1.52, and the amount of uh, money which is being borrowed by benchmark is 1.52, and the amount of money which is being borrowed by Soima Limited is 4.06.
as we seen that leverage of Soima Limited is 3.8, and leverage of benchmark is 1.5. What does this indicate? This indicate that Soima Limited has used its maximum capacity of leverage, and it has taken much more loan from creditors, and it has utilized its maximum liabilities. Benchmark has purchased its maximum assets through the source of equity. On the other hand, Soima Limited has purchased most of its assets by the source of liabilities. So that's why this is one of the reasons Swama Limited has higher ROE, return on equity, and then
So what we can conclude by looking at leverage of both of these companies, we can say that Soima Limited has taken maximum benefit from borrowing money. Okay, so this company has taken too much borrowing, and this company has purchased its most of assets through borrowing. That means the cost of creditor is less than the cost of owners. Okay, so the cost of liability is less than the cost of equity. That's why benchmark has less return on equity than Soima Limited. Okay, because benchmark has purchased its assets by getting maximum equity from their owners. Okay, and Soima Limited has taken minimum amount from owners. Okay, it has taken minimum amount from owners, and it has utilized maximum capacity of borrowing money, and it's purchased its most of assets through borrowing money. So that's why we know that the cost of capital, cost of equity is more than the cost of liabilities. So that's why here at the end, benchmark has less profit, and benchmark has performed hasn't performed better than Soima Limited, and Soima Limited has utilized its capacity of borrowing money, and it has utilized its maximum leverage. That's why its ROE is better than benchmark. So let's calculate efficiency ratio. So efficiency ratio will tell us that how much amount a company has earned through utilizing its assets, whether this company has efficiently utilized its assets or not. We will try to see that maybe the problem with benchmark is that it hasn't utilized its asset efficiently. So we will calculate efficiency ratio. So how we can calculate efficiency ratio? For calculation of efficiency ratio, we need to divide our net profit with total assets. Okay, so net profit of Soima Limited is 21,300. Okay, so the efficiency of Soima Limited is 0.034, and now we will see the efficiency ratio of benchmark. So the profit of benchmark is 21,300. Total assets of benchmark is 6 lakh 10,000. Okay, so both companies have same ratio, efficiency ratio, term of efficiency. So there is no problem with benchmark in term of efficiency. So because both companies have same efficiency ratio.
guys, when we look at efficiency of both of companies is same. Both of company has generated 0.034 efficiency ratio, and both have operated with the same efficiency. So there is no efficiency issue with benchmark. So there is no efficiency issue with benchmark. So because it has generated same amount of sales as it has been generated by the Swama Limited. So benchmark and Swama Limited has generated 0.034 in sales against each dollar worth of asset. So both have operated well, and both have operated with the same efficiency.
Now we will see that profitability ratio. Maybe there is a problem with benchmark in generating profit. Okay, so that will let us know that whether the performance of Soma is better because of profitability ratio or not. So let's calculate profitability ratio. For calculating profitability ratio, we have to divide our profit with total sales. Okay, so the profit of Soima Limited is, Soima Limited has profit 31,300. Okay, and this company has sales figure, this company has sales figure of 50,000. Okay, so here is the profitability ratio of this company, 0.42. So let's see the profitability of benchmark. Profit of benchmark is 21,300. Okay, and the total sales of benchmark is 50,000. So both companies have similar profitability.
As when we look at profitability, both of these companies has generated 0.42 in profit for every $100 of sales. Okay, so when we look at the profitability, both of companies has generated same amount of profit against the same amount of profit, and Soema Limited and Benchmark has generated 0.42 dollars in profit for every $100 in sales. So both have operated with the same profitability, and there is again no issue with the profitability, because profitability of both of these companies is same, as their sales is same, as their net profit is same.
So this is how we calculate the efficiency and effectiveness of companies, and this is how we actually calculate the profitability and efficiency of companies. So this is the way uh, we can reach to the problem of a company, and we can get to know that where company is performing less and where company is performing